I want to thank everyone for coming in during busy times. As you can see, most of us are working from home still in Chicago. I think we've got a broad-based network of folks who are dialing in from all over the country. So I know we're all in different spots on where we're at with the pandemic. My name, for people who don't know us, I'm Rob Fleetwood. This is the third webinar that Behringer-Ferrazzano has teamed up with RSM and Piper Sandler on this year. And we've gotten some great responses of just kind of sharing what we've seen and what questions we're getting from our broad base of clients. So today, we're going to have several professionals from Barrick, from RSM, and Piper talking about what we're seeing out in the marketplace. And you can see on the agenda, we're going to talk about the general economy, some strategic and M&A conversations that we've been a part of, what we're seeing in the digital and fintech type spaces. Litigation is always a concern, and there's some trends that we are seeing based on what we're going through. And then I always say the infamous Behringer-Geiringer Report, but I think it's more the famous Behringer-Geiringer Report that we'll wrap up with and then go to Q&A. So with that segue, I'll turn it over to John Behringer, who's with RSM, to do a quick intro, and then we'll jump right into the content.
Thanks, Rob. Appreciate it, and appreciate everyone again echoing Rob's comments, taking time to join us today. I'm really excited with the speakers we have on tap to share with you from all the firms. I know there's some familiar faces, but also some new faces as well. Certainly want to encourage you, particularly given we have access today to Kevin, who I'll talk a little bit more about his background in a second, you know, on the general economy and issues. So please feel free to use the Q&A at the bottom of your screen, and Rob Fleetwood and I will be monitoring that throughout the presentation and making sure we pass those questions along to the panelists. So from RSM today, we've got Christina Churchill, who I'm excited to have with us. She leads our financial institutions practice nationally and really has spent a lot of her career in banking on your side of the desk as a banker before joining the firm. And through that has developed a lot of insights around digital. And I think not surprisingly, as we continue to see every day, more and more community and regional banks announce reductions in their branch footprint in an attempt to kind of shift resources to the digital channel. Christina's going to share some insights around that and around a recent digital survey we completed at RSM. But I'm really excited to have with us Kevin Depew. Those of you who've attended the annual event that Barrick and RSM have traditionally had in the spring have had a chance, hopefully, to see Kevin a couple of different times present. I really use the word, it's a treat to hear from an economist, but in Kevin's case, it is. He's our Deputy Chief Economist at RSM, and again, I think is going to bring some really valuable insights here in the limited amount of time we give him here in our kind of 15-minute segments. So if there's something that he doesn't hit on that you have a question on, I would encourage you to go ahead and use that chat. But without further ado, I'm going to hand it off to Kevin to talk through kind of where we're at as we go into Q4 here of 2020.
All right, thanks so much, John, and thanks everybody for tuning in and listening to us. I thought it would be a good place to start with where we were pre-pandemic in terms of the broader economy, our forecast for this year, because when we're talking about recovering, it's helpful to understand what exactly are we recovering into. And so the baseline prior to the pandemic, our forecast gives us a little bit of a sense of what we might be able to anticipate the other side of the pandemic looking like. And so I think this slide in particular was from presentations I was doing on the road in late January, early February. And so our forecast for the year at that time was for a continued deceleration in economic growth from sub 2% in 2019 to about 1.5% for the full year in 2020. And there were a couple of things that were driving that sub 2% growth. The first one is that you had a very strong consumer, particularly in the top 2 quintiles of income earners, those that have really so far withstood the brunt of the job losses that we've seen in the broader economy so far through the pandemic. They were really, that 40% of income earners account for about 60% of spending. They have very clean balance sheets, very well positioned to continue spending, even in the pandemic. And so that was why we hadn't really tipped over into a recession as sub 2% growth. Now, the headwind was obviously capital investment, weak business investment on the parts of businesses. And that was really driven by a couple of factors that were long-term. One is a little bit of a risk aversion hangover from the Great Recession, where even on the parts of households, what we view as acceptable levels of risk post-Great Recession were not the same as prior Great Recession. So that was one headwind. And the other one was really related to some indecision about how to invest for the future. When you're talking about even upgrading things like moving storage to the cloud, you might have 150 available vendors and with all types of different solutions in just one area. And so it was very challenging for a lot of businesses, particularly in the middle market, to be able to make those types of capital-intensive upgrades and business decisions. So we'll come back to that when we get to the end, that key theme. A couple of other things that you all know, Fed likely on hold prior to the pandemic, inflation slowly getting back toward 2%. The risks at that time of the outlook were largely centered around the potential for a reacceleration of the trade war. So a policy error on the part of the administration, or a central banking error if the Fed, for example, raised rates too soon or engaged in some kind of activity, reduced their bond buying, for example. All those things could have created some additional risk. When you're sub 2%, it doesn't take a lot to tip the economy into recession. And then finally was COVID-19, which we at that time viewed more as a liquidity event, certainly not the all-encompassing pandemic that we've been forced to deal with. Next slide, please. So if you talk about where the economy is now, it's true the economy is recovering, but that progress is now stalling. And it's largely being held back by policy disagreements in Washington, D.C. Household consumption remains a risk due to that lack of fiscal support. And so the major risk to the economic outlook going forward is the potential for a second wave, which is what Europe is experiencing even now. So whether you're talking about UK, France, Germany, almost all of those locations have now seen daily COVID-19 cases exceed on a daily basis the levels that they had seen in the spring. Now, in terms of policy response, the policy impasse remains a cornerstone of how the economy is going to recover from this. When we go back to the initial policy responses in the 4 phases there, the ones from the first 4 phases on the part of fiscal policymakers, those were largely stopgap measures to avoid disaster. So I would not classify those first 4 phases as stimulus. So what is in limbo right now is actual stimulus for the economy. And that's one of the reasons that I think that we all have to give policymakers a little bit of the benefit of the doubt that those two sides will have to hammer out an agreement. Hopefully it occurs sooner rather than later. But they did respond very quickly in the initial phases, as did the Federal Reserve on the monetary policy side. Now, in terms of the shape of the recovery, there's a lot of talk about a K-shaped recovery. Our view is that this really goes back to the 90s and what we've seen accelerate not only when we got to 2001, 2002, the unwinding of the corporate debt bubble, the dot-com crash, and then accelerating again in the Great Recession, and now even further is a K-shaped economy. And so that's where you have one path, those top 2 quintiles of income earners, people who are in professional and services, people in high tech, that those are the areas of the economy that has largely benefited over the past 10 to 12 years. And the people on the lower shaped, that lower path of decay are the consumer facing, typically the lower wage earners who had only recently began to see prior to the pandemic, their wages begin to accelerate the way that those people on the upper K path have seen for much of the past decade. So in terms of the recovery, I think we have to anticipate that this is going to continue to be a very elongated and frustrating recovery in some industries. In terms of even in financial institutions, You've seen some preview earlier this week of earnings, a little bit of a mixed bag. Some are withstanding what's happening better than others, and it's largely dependent upon how tied your business is to those consumer-facing activities that have still not quite fully recovered. Next slide, please, Mr. So right now we have about 25.2 million people who remain on some form of unemployment assistance, a significant amount. We saw today initial jobless claims again reported. It's just shocking to see these numbers come in. Just so you know that in the history of that data series, going back to the late 60s, there were 2 weeks, one in the early 80s, and then one at the heart of the Great Recession in 2009, when you had initial jobless claims at their peak of 600,000+. We haven't even recovered back to those levels that were prior associated with severe recessions and problems in the broader economy. So, while it's great that we continue to add new jobs at a record pace, we've really only recovered a little more than 50% of those jobs that are lost. 25.2 million people remain on some form of unemployment assistance. That's going to continue to be a problem going forward. And it just remains to be seen whether that starts to impact that upper path K, where a lot of businesses, a lot of income earners have largely been shielded from that. We've talked about the $15 billion per week in lost government income support. That will accelerate if we get over the next couple of weeks into the election without any kind of government support. Inflation, I know that usually that's a question, is when will inflation become an issue? Longer term, it most assuredly will. We have so far provided about 11.4% of GDP in fiscal assistance to the economy. That will show up, but in the near term, the greater risks, especially on the business side, are disinflation and deflation. The inflation is not going to be today's business, or probably not even next year's until we get toward the end of the year. Next slide, please. So this is the Moody's Analytics and CNN Business Back to Normal Index. It essentially compiles a lot of real-time data in the economy about what's happening and gives you a sense of those areas that are largely closer to normal and those that have not. Unfortunately, those darker areas which have seen more normalized activities are the very states where we've seen the COVID-19 cases start to significantly increase. So we're only at about 80% of capacity. I don't think that until we get through the winter months and toward the end of the year, when you start to get either therapies or the potential for a vaccine by year's end, that you can really anticipate the economy moving back toward 100%. Next slide, please. So just to talk about a couple of scenarios, obviously the most optimistic scenario would be that we have just one single pandemic wave, and I would characterize what has happened in the Sun Belt and the South and what's happening in those Midwest states. That's really an extension of the initial pandemic wave. In fact, a lot of those regionalized COVID-19 breakouts in the Midwest can be tied to that super spreader event in Sturgis that happened late in the summer. So that continues to have an impact. What is more likely is the second scenario, where we do have a second pandemic wave in the fall, winter. We have to experience some regionalized lockdowns, and the recovery that back to 80%, back to 100% normal index probably doesn't really happen until the second half of 2021. What would be more problematic is the third scenario, which I would consider less probable than the second. And that's where you have persistent pandemic waves and you have regionalized lockdowns with the recovery really not happening until 2022. So in terms of the steps to fully reopen the economy, it's not a one-size-fits-all approach for the U.S. economy. 330+ million people, a wide array of geographies, different concentrations, different medical infrastructures in major cities, different access to medical infrastructure in rural areas. All of those things entail a different response. Remember, the goal is not to prevent anybody from getting COVID-19. It's obviously to, in some way, manage the economy while at the same time protecting our most vulnerable. And you have different needs depending on where you are. If you're in a city like Tampa that has widespread access to medical infrastructure and is not in danger of having coronavirus cases swamp your medical facilities. That's obviously different than what we experienced here in New York City in the spring when the medical institutions were completely overrun, the infrastructure incapable of keeping up with that kind of demand. So those are the types of considerations. And so I would be a little suspect of people who come out with some kind of one-size-fits-all approach to the national economy. Next slide, please. So rather than leaving it with things that are obviously dire, we're in the middle of a pandemic. It's difficult on the business side as well as the household and the personal side. I thought I would leave with a couple of things that are positives that could go right. Now, I put this together with the initial slide that I showed from January. And so over the course of time, there are some things that we can take off. So obviously, healthcare spending as a percentage of GDP is not going to drop, not in the near term. Unemployment rate at a historic low. That was a nice thing to happen going into a severe shutdown of the economy, but obviously that's not going to return to normal for quite some time. But some things that are going right, innovation taking off, the potential for the exodus from some metropolitan areas, New York, San Francisco, San Jose, for example, to more rural areas, creates additional demand that can also lead to things like 5G being more available, which would be a significant increase not only to the desirability of businesses to locate in rural areas, but also in terms of just regular quality of life. If you have a pre-existing medical condition, for example, that requires frequent hospital visits or doctor visits, if you live 90 miles from a quality medical institution, then there are changes in telemedicine and 5G that could dramatically impact your quality of life and just managing an ongoing existing condition. In terms of longer term, a couple of things that I think that the election, when we get past this, will likely be viewed future generations as a low watermark in terms of polarization. The reality is that millennials have now surpassed baby boomers as the single largest cohort in the workforce. They remain very young, and as they start to age into those policy-making roles, I think that some of the attitudes that millennials share about collaboration, for example, will be hallmarks of the coming decades. So we're not always going to have what feels like a very polarized Washington, D.C. And you're also seeing an increased interest in policy making at the local and regional level. And I think all of those things go to make for a healthier environment in terms of policy making to meet some of the challenges that we're going to have to deal with. And some that come to mind are labor replacing technologies. The reality is that we are on the cusp of very significant labor replacing technologies, and those are being accelerated as a result of the pandemic. That unbalanced growth, the K-shaped economy, it is unfortunately a fact that if folks on the lower K path, that they feel like there is no chance to move from that path to the upper K path, then you have a society that will not function properly, period. There's just no way around it, and it's reached such an extreme over the past 25 years that it has to be addressed by some form of policy. And so I'll leave it to your imaginations about what those policies might be, but it certainly will be a different, in our view, environment for businesses going forward over the next 20 years. And so I think I ran a little bit, a couple of minutes long, so out of respect for my colleagues, I'm going to turn it over quickly now to John Freechak to talk about some M&A specifics.
Great, thank you, Kevin. And now great analysis there. And this is John Freechak with Piper Sandler, and I'm going to give the perspective from the investment banking side here. And it's nice to be able to talk about some actual merger activity in the community bank space for the first time in quite a long time. If you've been on the last couple webinars we've had in the spring and the summer, you know, it was really just a hypothetical trying to figure out what needed to occur to get back to an environment where you might finally see some merger activity again in the bank space. And we're finally starting to get a little bit of clarity here. As Kevin just did a great job describing, we are far from out of the woods, but knock on wood, we at least seem to be taking some of the more dire predictions that we saw 3 or 4 months ago in terms of potential credit losses in the industry off the table. And so to give a sense of what we've seen finally in M&A activity, a lot of the recent announcements have been driven by deals that were, if not half, half baked or possibly just about fully baked prior to the pandemic. And so, these recent deals have been transactions where there was a price agreed to back in February, and they kept discussions going throughout the spring and summer, finally got comfortable with diligence, and were able to get to a recent announcement. These have not been auction processes that kicked off in June, for example, that you're seeing getting announced in recent weeks here. And so that level of familiarity, I mean, that's really, I mentioned clarity, and I'm going to hit on that point a few more times here, but it's transactions where there is a level of familiarity between the parties that's allowing them to move forward despite some of the uncertainties that Kevin just described. And so that's a really important dynamic where, if you are a bank and there's a competing bank that you've known for the last 3 or 4 decades, you can look across the table from them and say, I understand your credit culture, you understand mine, and if something's going to happen that's going to impact our local economies, it's going to impact both of us. And so the mentality, and this really hits, what's driving some of the recent merger of equals activity as well, it's that mentality of, on a combined basis, we're going to have more scale, we're going to be able to cut some costs, and we're going to put the best team on the field, whether that's for defensive purposes going forward or offensive. And either way, we're going to be better positioned to weather whatever, as Kevin described, 2021 and beyond has waiting for us. And so that's the mentality. It's not transactions, and for at least another couple quarters, you're not going to see deals, for example, a Wisconsin bank moving into the Minneapolis market for the first time. Those aren't the types of deals that you're seeing, and that's not what you're going to be seeing for the next couple of quarters here. And so keep in mind as well, when I talk about the recent uptick in M&A activity, like everything else in this environment, it's all relative. It felt like we were turning a corner in August, and you look back on it and there were 10 deals announced nationwide, and it felt like a big month. And so, it's still not to the levels that you have seen in the past handful of years where you would expect to see 25 deals announced in a month. But there is finally some activity taking place. Now, here in the Midwest, we saw our first transaction of much scale recently with First Mid in Illinois acquiring Providence Bank in Missouri in about $150 million transaction value deal. And what's interesting there is that involved First Mid, which is a publicly traded bank, and like just about all publicly traded banks, they've seen their stock price decline by 30+% over the last 6 months. The broader market has come back, bank stocks have not. And so you're seeing the impact that has on M&A pricing as well, where that transaction, a $4.5 billion bank acquiring about a $1.2 billion bank, was priced around tangible book value. And so, you get a sense there where if bank stocks are off 30%, that is having and will continue to have an impact on their ability to pay in M&A as well. Now, we've also seen a number of privately held banks acquiring other privately held banks. And as we all know, earnings have held up for the most part in the industry. And so, but the issue, of course, is going back to what Kevin just did a great job touching on, there remains concern looking into the future here of what's going to drive earnings or growth going forward. And so we've seen earnings hold up thanks to mortgage, thanks to some PPP loan income, fee income. But going into 2021, this interest rate environment isn't going to change anytime soon. And where is any kind of loan growth on an organic basis going to come from? And those are some of the challenges you look at from, the management teams as we're finally, we're getting into budgeting season right now and trying to figure out where is that growth from an earning asset and an earnings perspective going to come from going forward. And it's going to be a real challenge. And it's part of the reason that you're seeing mergers of equals. We've seen a little bit more activity in that space. You're seeing some cost-cutting initiatives be announced by some of the larger banks. Northwest Bank in Pennsylvania just announced they're going to close 20% of their branches. Associated and Fifth Third recently announced some cost-cutting initiatives. Those are the kinds of things that are driving earnings going into 2021. Now, again, to end on to this topic on a little bit more on a brighter point, The good news is that we are seeing loan deferrals drop dramatically at the vast majority of our client banks. And so again, it seems like credit is becoming a little less wild of a wild card at least, but until we get, some of those points, talking about, when are we going to get the stimulus package passed? When are we going to get some clarity on the election? When are we going to get some of that clarity in terms of Kevin's 3 scenarios on COVID? Have a better sense of which of those paths we're actually going to take. Until that occurs, you're still going to see muted activity in M&A. Once we have that clarity, look out, because there is some pent-up supply right now in the M&A space. And once we have that clarity, expect to see activity jump quite significantly. So let me pause there for a minute. I'll kick it over to Emily Hinkle at Barrick to give some thoughts in terms of the impact that this environment is having on trying to perform diligence and other matters from an M&A perspective.
Thanks, John. As you said, with all the questions surrounding credit, we think that it makes a lot of sense that there's a lot more emphasis these days on due diligence, getting into those loan files, looking at credit quality, mainly looking for borrowers and what industries they're in, and if any of them are in any industries that are particularly impacted by COVID, just so that acquirers have a better sense as to what sort of risk portfolio they're getting into. And another item to be thinking about with respect to M&A activity are the regulatory. For example, depending on the structure of the acquisition, if you've got a credit union purchasing a bank, it depends on what state you're in and who needs to approve it. That'll determine how easily that actually gets approved. And one other item that we've noticed is that a lot of these transactions are taking longer to get regulatory approval. And with transactions that require the approval of the Federal Reserve, we've heard that on an informal basis, the Fed in Washington is taking a look at these applications. They may not be taking over full approval authority for those, but they're still looking at them. They're still commenting on them. So just things to keep in mind, that there may be another set of eyes on your application, and it may cause some delays. So I'll kick it back over to you, John.
Great, thanks, Emily. And I'm just to touch on the capital markets briefly, as we've talked about in the past webinar too, for community banks, the headline item remains subordinated debt. And we have had a record year by a wide margin in the community bank space in terms of issuing subordinated debt in the capital markets. And it is continuing to grow. And so, if you have not issued subordinated debt yet, that is an avenue that you certainly can consider. For banks of all shapes and sizes, that market is wide open right now. And we are continuing to see coupons on those issuances drop down to levels that you would have expected to see pre-pandemic. Now, it certainly helps considering where treasuries are trading on a relative basis there, but nonetheless, we've had some recent issuances that have broken through the 4% threshold and have been 3-handle issuance in terms of the rate, the coupon on that subordinated debt. Why is that? Well, what's driving that is you do still have your typical larger buyers of sub-debt in the insurance space, money managers, but community banks, as we all know, are sitting on a mountain of liquidity right now and are looking at this versus their alternatives. And as long as you can get comfortable with the credit element of a potential issuer, another community bank, they're looking at that and saying, well, geez, at 4 or 5%, I know Bank XYZ, I know that management team, they run a tight ship there. That's not a bad thing to be sticking in our investment portfolio right now. And so we're continuing to see new, community banks enter the market, not necessarily as issuers, but also as investors in the community bank sub-debt space, which is really helping to drive some of these coupons down to that 4% level. And right now, there's no sign of that slowing in terms of community bank appetite for subordinated debt from other banks. So that's been an interesting dynamic to watch unfold. And Emily, I'll let you kind of touch on anything on the capital markets there as well before we jump into corporate governance.
I think we can go over to corporate governance. Next slide, please. So just kind of wanted to touch on a couple of items that everybody should start thinking about, kind of as you move into next year. The Fed recently extended the restrictions on banks over 100 billion in assets from stock repurchases, and that extends through the end of the year. For banks under 100 billion in assets, that restriction is not in place. So we're starting to see more banks, that maybe paused their stock repurchase programs back in March, starting to take a look at their stock repurchase programs again, dusting those off, and starting to repurchase that. And as a reminder, you should take a look at this in connection with what your capital needs are, and all of your capital planning, and review the factors in the supervisory guidance 094 to make sure that you are taking into consideration all of the capital factors required by the Fed. One other issue on 094 is that at the end of July, the Fed issued additional guidance, and this is mainly regarding companies that want to issue a dividend for a period or a quarter that exceeds the amount of their earnings. So this additional guidance provides that if you consult with the Fed on this, and you should consult with the Fed on this, they will respond to you in 2 business days if certain factors showing good capital levels are in place. For example, that your net income for the past year is enough to pay for your dividends for the past 4 quarters. You're not anticipating any stock repurchases, no concentration in CRE, and otherwise in good supervisory position. If that's not the case, then they say that they will get back to you in 5 business days, but that guidance also provides certain information that they're looking for regarding past due assets, criticized assets, ALLL levels, and so that kind of gives more guidance for companies about what that is actually looking for. Next topic that we think is going to be, on people's minds are ESG disclosures. So given the current environment, we believe that there will be increased focus on gender and racial diversity on boards of directors. And so as a result, it may make sense for your company to look at your policies and succession planning board, but also with respect to management and with respect to your workforce, and maybe determining whether a diversity policy should be put in place and how it should just be considered in general. And recently, the SEC also changed their rules applicable to public company disclosures regarding human capital. And starting with the next Form 10-K filed by companies, human capital disclosure will be required. The SEC generally takes a position of, well, this depends on what your company is and kind of the industries. So it's going to be very different from company to company. And there aren't really any good examples out there yet for exactly what type of disclosure is going to be made. And so I think that it makes sense for boards of directors and HR departments to start thinking about what types of disclosures make sense for your company. This could include information about number of employees, the diversity of your workforce, any recruitment and retention efforts, training efforts, or succession plan. And then as more companies are disclosing this, these disclosures will probably evolve over time to kind of, set metrics that people generally disclose that they're focused on. Very quickly, I'm going to touch on annual meetings. COVID kind of hit right at the beginning of proxy season last year, and so I think there was a little bit of scrambling to figure out what are we doing? Are we postponing? Are we having people in person? But just a reminder, start thinking about this early, about whether you want to have a virtual meeting or a hybrid meeting with an in-person and a virtual component. And also make sure that you check your state law, articles, and bylaws to make sure that the way that you're doing complies. And finally, on executive compensation, the compensation metrics that you may have used in past years may not be appropriate for this year. So start thinking about that early to determine what would be appropriate metrics now and start meeting your compensation committees on that. So with that, I will turn it over to Christina Churchill from RSM.
Thank you so much. Well, I think everybody gave me a great lead-in to talk a little bit about digital transformation. And a big thing that we've seen with everyone throughout this pandemic is really, how do we do better with what we have? And they're reevaluating the way we've always looked at staffing and really our workplaces today. You know, a number of our institutions have closed their lobbies completely. We have some that are doing by appointments or some that are utilizing drive-throughs. But what we've really found is we're really more focused on utilizing our app as not only our front door, but the totality of who we are. And so what I'm hearing from people in the marketplace is really that, you know, we've been able to do a lot of things really well, but we have some gaps. And that's really what the digital proposition is about. You know, looking at sort of the strategy that you have for your institution and what do you want to do as you continue to move forward through this unknown time, you know, as we continue to work through these months. You know, and people are really focusing on sort of those people, the process, and the technology and how we're best using them. One of the areas that we do see some concerns is really finance and accounting. We're able to do a lot of things remotely, but we still get paper checks, or we still get mail, or still need to send out invoices and those type of things, or the statements to the customers. And so how do we work other ways to accomplish that? And we do it through a few different things. In some cases, we found that integrations weren't built. You know, our core system to our loan subsystem, maybe that integration wasn't built correctly. And some of those manual efforts are coming to a forefront, which is actually awesome because now we have the ability to fix things that maybe we didn't know were happening. We're also taking that time to really look at what are those different technologies that are available to us that are able to augment what we already have and to fill those specific gaps. One of the ways people are doing that is they're really looking towards outsourcing. You know, are there components within the organization that we should outsource to a third party to be more effective? And then finally, we're of course looking towards our risk, our fraud, and security with everything that we're doing. It has become a much larger issue, just like we're all stuck at home, all the hackers are stuck at home too. And so there's been many more incidents that have occurred, and we're seeing a much higher insurance claim based on the latest survey data that's coming through. But we also have a number of occurrences where people are using you know, you bring your own device. And so they're utilizing different equipment than perhaps what you would have utilized within your four walls. So if we go to the next slide, John touched on just a little bit that we did a survey related to digital transformation just before the pandemic hit. So this was a little bit before any of us knew what was going to happen, and we surveyed, we have 100 different bankers that responded to this across a variety of different asset sizes. And I brought just one page today from the totality of the ebook, but I thought this really tied back to a lot of the different topics that we were hitting on today. So pre-pandemic, we said that the things that were most important to us and where we as bankers were going to put our digital investments were towards a frictionless customer experience. And that's exactly what we need now, right? People need different ways to be able to bank, and we need to be able to serve them where they are in the way that works best for them. And so really focusing on those mobile applications and the ability to meet their needs. You're starting to see a number of different advertisements. There's some different commercials running on TV now. We're starting to see pop-up ads on a number of different websites that are really focused on how we, our institution, can serve you better because. And that's a big part of what we're looking towards here is what are those things that we can do? And that's a place where the bankers felt they should put a spend. The other item is really about scalability. And this also, you know, matches up nicely. As we're having more and more people hit the network, and we have more and more folks that are coming to us across the internet as a whole, do our systems scale to what their needs are? Are we able to serve them? Do we have folks, call center folks, that are able to provide the various different IT support that they need? And do we have the systems that work timely so that as we're talking to them, we're able to pull information very, very quickly and to make it be a real-time experience for them? We're looking towards expanding our service offerings. What are the things that are most important to people? And this is a great time for us to really take a look at the traditional banking products we've always had and reevaluate what is the most important for today's consumer base. You know, we've all talked for years about the shift through the generations and what's going to happen with that, but we're now seeing an even bigger shift in what we've done because of everything being done remotely. But most importantly is, of course, coming back to the product and service quality. How are we serving our customers? Do we continue to give them the epitome of service that we've always said, you know, is the #1 thing about community banks, right? So how are we doing with that today? And are we able to do this from a process and cost efficiency? And this is really where people are coming back and taking those harder looks at what are the things that we're doing? Are we doing it in the best way? You know, do we need to shuffle people and shuffle responsibilities to make things be a little bit more effective? And so one of the ways that people are really doing that, if you go to the next slide, is really looking at what are the automation options that are available. And this was actually the #1 request that sort of came out of the survey, is people are focusing specifically on not only RPA, but really all of the automation options, whether it's AI or low code or fintechs or a variety of different things that are out there. But how can we do better with what we have? And so really all that RPA is generically is it's creating a repetitive task automatically for you. And so it's allowing you to really find that right ROI for you and your institution. What I've found is oftentimes people get stuck with, I have to automate the totality of a process, but not necessarily. We have a bank that we've recently worked with that we just did a component. So they were doing a loan review. And at the beginning of each of their loan review processes, someone had spent about an hour going and pulling all the various different files and documents that they needed just to start. And so we were able through RPA to pull all of those for them automatically by simply saying these are the loan numbers that they were going to be looking at on that day. And so they were just all available to them in folders. They could just see everything on one shot before they did the review. So they kept the human element and the human intelligence of doing the review process, but they cut out all of, you know, sort of the administrative time to it. And so that did a couple things for them. You know, it got the data quicker. They were able to do more loan reviews within a given time, but it also increased sort of the quality of life of the employee that, you know, nobody wants to go and grab files all day. And so we're really looking towards what are those things that are most important for you. And these items can really be ran across any of the different components within your institution. So I thank you very much, and I'm going to go ahead and move it on to Scott.
Thank you, Christina. My name is Scott Porterfield. I'm a partner at Ferrazzano and been asked to speak about litigation and class actions regarding banks, which is obviously a very broad topic. So I've tried to narrow it down to 4 topics for the limited period of time we have today. The first is class actions continue regarding overdraft fees. Banks and credit unions have continued to be sued. In fact, I saw a spate of lawsuits filed this year. We're involved in a handful of them. Just to give you the enormity of the potential liability, late last year, TD Bank agreed to pay $70 million to settle an overdraft fee class action in the Federal District Court of South Carolina. They just announced that late last year. That settlement is still working through final approval with the courts. I've noticed that the class actions that have been filed this year, the focus has shifted on the theory with regard to the overdraft fee that's being attacked. Initially, as you probably all know, a few years ago, Wells Fargo and Bank of America was sued in class actions. And the focus then was on the ordering of the items that were being processed, and the ordering being from the highest item to the lowest item. Now the focus is on the NSF fees. I'll just give you an example of a lawsuit, a couple lawsuits we've seen filed this year, where a bank is charging $30 for an NSF fee, and the customer goes to Walmart, writes a check for $100. The check is presented, and the bank does not honor the payment because it would create an overdraft, so returns the check, charges the customer a $30 NSF fee. And then a few days later, the merchant or processor represents that same check. The bank again denies payment and charges a second $30 NSF fee. Class actions and the plaintiff's lawyers have focused on the wording of the disclosures by the bank. And many times you see in the disclosures that the bank's simple disclosures on the NFV says, I'm going to charge you $30 for an NFS fee per item. Item is not necessarily defined. The term item is singular. So plaintiff class action lawyers then allege that that second NSF fee that you charge for that same presentment of the single check is a inappropriate breach of contract or violation of state consumer fraud statutes, what have you, whatever their theories are. So my practice tips for all of you are that you ensure that your disclosures regarding your overdraft and NS fees are very, very explicit. If in fact you're going to charge a second NSF fee on the same check, make sure you define that in your disclosures. Make sure your disclosures are robust and explicit. In addition, make sure that your contracts and your disclosures with your customers include arbitration provisions and class action waiver provisions. I'll tell you that we're involved in a suit right now on an overdraft fee case. We've advised the plaintiff counsel that the disclosures that were given to the named plaintiff customer, in fact, did contain an arbitration provision. And that firm is now mulling over whether they're just going to drop the suit, because plaintiff class action lawyers don't want to proceed to litigation over $300 in overdraft or NSF fees for a particular customer. The only way this is a payday for plaintiff class action lawyers is if they can make it a class action. So if you have arbitration provisions and class action waiver provisions, I can assure you, you'll immediately cut off that lawsuit. And I apologize for the train going by my house right now. I apologize for the background noise. Please, next slide, please. Next slide, please. Yeah, COVID-19 related litigation. This is clearly now new. We're in a brand new world, as we all know. And COVID-19 is going to generate a phenomenal amount of litigation, a lot of it class actions. Just to touch on a handful of the topics that we're seeing as a result of COVID-19. Obviously, with the CARES Act and the PPP loan program, there have been a number of class actions filed by borrowers or prospective borrowers, customers who obtained loans or tried to obtain PPP loans, class actions against banks and how they process their loans. Some of those class actions allege that banks prioritize their largest customers and process their loans first. And at least in the initial wave of PPP loans, some of the smaller businesses didn't get their PPP loans, and they claimed that banks were preferring the larger clients and customers. A very early case filed in Maryland, plaintiffs sought an injunction because they claimed that their bank didn't prioritize their loans and they were going to be shut out. They sought an injunction against the bank. The Maryland court denied that injunction, found that the CARES Act did not create a private cause or private right of action for plaintiffs, that only the SBA had the authority to enforce the PPP program. That particular suit is up on appeal in the Fourth Circuit, so we'll monitor that and see how that plays out. There are also some potential regulatory enforcement actions that I'm sure are going to be brought down the pipe for violation of fair lending practices or BSA issues, all in conjunction with the PPP loans. I'm sure there will be additional wave of class actions after the forgiveness phase goes through. Some clients are going to, maybe they don't get their loan forgiven, and so they're going to sue their bank and bring a class action claiming that their bank or their loan wasn't forgiven because of something the bank did in the processing of that loan or the processing of their application for forgiveness. So we're in the very, very early stages of PPP related and COVID related class actions. I do want to note that, of course, anytime the government pumps out $6 trillion of stimulus to the economy, there's going to be fraud. I've seen that there have already been some criminal actions filed for folks that tried to get PPP loans. They created sham companies. They obviously created, a portfolio or resume of, well, we have 50 employees we need to keep employed, what have you. Some of those companies turned out to be fraudulent. And so the government, the DOJ, is going to be carefully monitoring that. I expect to see a lot of criminal actions over the next few years. We also have, obviously, COVID-related illness suits. Suits by employees, although generally you're protected by your workman's comp statutes, but I'm sure there'll be some employees who try and get around that and the exceptions that workman's comp statutes have. And then customers, they may walk into your facilities, go back home, and a week later get diagnosed with COVID and claim that they got sick because they were in your premises. And there may be class actions as a result of that. I'll note that my partner, Allison Powers at Barrick, just issued a client alert. So be on the lookout for that from Barrick Ferrazzano. Just went out yesterday or today, I think, that touches on some of the employment-related suits that you can expect relating to COVID. In terms of the overall PPP defenses, just to throw it out there real quickly, obviously you'll want to hang your hat on the fact that there's no private right of action under the CARES Act. And you'll also, depending on what kind of state law claims are asserted, you might want to be able to assert a federal preemption defense. So look at that too. In terms of my practice tips, particularly since you're going to be in the throes of the forgiveness stage, continue to be vigilant about conforming to all your lending practices and your loan policies and procedures. And then with regard to health and safety, continue to follow all CDC, state, and health guidelines in your community. Next slide, please. The third topic is the ADA accessibility suits. These really picked up late last year and are continuing. And the suits focus on the alleged allegations that disabled folks, whether hearing or visually impaired or other disabled customers, don't have access to the bank's website or the bank's mobile applications. In Chicago last year alone, we saw a single visually disabled customer or tester filed over 50 lawsuits in Chicago last year using the same plaintiff law firm. And again, he was testing companies' websites, including a number of our bank clients, and claiming that they did not meet the accessibility standards for the websites. I'm sure you all know that the Department of Justice is the organization, the entity that's really charged with enforcing the ADA. And unfortunately, the ADA has not issued any specific guidelines as to what constitutes sufficient and adequate accessibility for websites and mobile apps. There was some talk during President Obama's administration that DOJ was going to promulgate those standards. Then we had the Trump administration come in, and regardless of what your politics are, the DOJ took the position under the Trump administration that they were not going to be publishing guidelines. This upcoming election may or may not change that. But the good news is, and I do at least have a little bit of good news to offer you, is that on October 2 of this year, there was a bipartisan bill that was introduced in Congress that's called the Online Accessibility Act. That act would amend the ADA and would set clarity and would set forth the standards for what constitutes compliant website accessibility. I'm not a technocrat, but I can tell you that under the proposed bill, the WCAG 2.0 level A and level 2A standards would be deemed to be acceptable. So banks, if your website and your mobile apps comply with that standard, you would have a safe harbor. Now, obviously, we're in an election year. Congress is going to be reconstituted in some fashion or another. So nothing will happen on this act, at least until that occurs in January. I would hope that common sense would then have Congress expedite this bill but we know common sense sometimes doesn't take place in Washington. So we'll monitor that statute. But please be sure that your websites, your mobile apps that you're looking at that meet at least the 2.0, and I would recommend if you can meet the 2.1 WCAG standard, you strive for that as well. So in my practice tips is exactly what I just laid out in terms of monitoring that for that standard. Depending on the size of your bank and the folks that you have employed, if you don't have somebody that's dedicated to monitoring your website accessibility and your mobile app accessibility literally 24/7, then there are a number of vendors out there that you could look at who can provide you with that. It's critical that your website and your mobile apps are monitored continually. Next slide, please. Obviously, cyber and data protection remain very hot issues. On October 8th, the OCC imposed a $60 million civil money penalty against Morgan Stanley Bank for failing to protect customer data. That particular action arose because Morgan Stanley Bank was decommissioning a couple of its facilities. Obviously at the facilities, there were computers, hard drives, a number of, obviously equipment that had customer data on it. Morgan Stanley Bank retained some some vendors that come in and help it actually swipe computers and make sure that they try to protect the customer data that was at those facilities. Apparently, that wasn't done to the satisfaction of the OCC. The OCC believed that customer data had not been properly protected, so imposed the $60 million CMP against Morgan Stanley Bank. Not surprisingly, plaintiff class actions ensued, and customers will be pursuing Morgan Stanley Bank for, I'm sure, a multiple of that $60 million fine. So as my tips here, please, cyber protection has to be one of your most serious operational concerns. I received an email this morning from Barnes & Noble. I'm a customer of Barnes & Noble. They notified me this morning that they'd been hacked yesterday. They claimed that customer information regarding to financial credit cards, et cetera, had not been accessed, but they're still evaluating that. Obviously, that's not a bank, but it just shows you that literally every single day, fraudsters are trying to tap into and get access to your data and your system. Obviously, I'm happy to answer any questions at the end of this for Q&A, but right now I'll turn this over to the two Johns for the Behringer-Geiringer Report.
Thanks, Scott. And now you won't have to hear us say next slide. As usual, John and I will be working without a net. So nice to see you all virtually, and nice to see you virtually, Mr. Geiringer. It's been a while.
And you the same, and I won't be asking what you're wearing under the camera line.
A good magician never gives away his secrets, right? Just like the weatherman. So I think with that, one thing I'll start out with, and then John, you can jump in here and swing away as well, is I think Scott touched on something we've been tracking closely in working with clients on Ppp, which is the fraud concerns. I think if you looked at American Banker this morning, you saw Wells identified that they had employees that had applied not under Ppp, but under the EIDL program and gotten funds that they shouldn't have. And they've since taken action to obviously terminate and separate from those employees. But I think more broadly kind of points to just in general and what we've talked about within the firm and with clients who did a fair amount of Ppp loans, in particular for that pool that wasn't already a customer, right? We saw after kind of that initial round that Scott alluded to, where we saw the big banks kind of in some borrowers' mind prioritize borrowers over others. We saw our community banks in particular step in and fill that gap. But in bringing on new clients and new borrowers in a quick time frame, making sure you kind of went through your BSA process, because I think when we look at this, and I'll let John be the attorney here, but I think the linchpin I would expect the regulators to look at, and they're going to point back to as, while we did all this quickly, bank, you know, a key provision was you needed to follow your BSA policies, right? And a key part of that is monitoring for unusual activity. And so something we've been talking to clients about is not only doing a triple P review of kind of your program, particularly the front end, call it a post-mortem, but on the back end, how have you kind of integrated that with your BSA program so when the SBA comes knocking a year or two from now, you don't have any kind of nasty surprises there? John, what are you seeing and what are your thoughts along those lines?
Yeah, there obviously a lot of bankers have been spending a lot of sleepless nights working on PPP. To their credit, they have been the heroes in this crisis. And what we have seen is that the regulators have said they'll give some degree of flexibility to banks in connection with what they've done. But the important thing they keep stressing to me when I talk to them is that you've got to document to the extent you're changing your policies to navigate around PPP, or in the context of loan modifications or anything you're doing in connection with the pandemic. They'll give you a little bit of leniency, but it's very important that you keep track of things like fair lending. You keep track of things like, are you changing policies and procedures? Are you getting relevant board approval for some of these things that you're doing? And I think that plays into the broader context of what we're seeing on COVID generally. That, you know, you can work with your regulators on things like scheduling examinations. You know, we have one client who unfortunately was hit with COVID pretty hard, and they had to reschedule and they had to reshuffle, and the regulators are generally amenable to that, notwithstanding their tight examination timeframes, but it's important you get to them sooner rather than later. It's also important that you have ready to go to the extent you need to close branches. And I know Illinois, for example, has developed a new form for the state charter banks in terms of how they want to be notified of any state branch notice on closings. And it's interesting, I even had a discussion where the examiner got it wrong. The examiner thought that if you reduced some of your activity at a branch, you still need to file one of these closure notices. That's not the case. It's actually if you close the entire branch to human engagement is when you need to close it. So even the regulators sometimes are getting their own guidance wrong, and we're all dusting off the rule books on these sorts of things.
Yeah, and I think, John, you raise a really good point there too, is, and some of this outside of the banking realm, but also if you're making significant changes to your workforce as a result of whether it's a branch closure or other changes kind of as we look at kind of workforce enablement, thinking about, is there things I need to consider from an employment law perspective? So again, I'm not going to play that role, and I know you probably won't either, but you certainly have colleagues that are more than able to fill that gap. So I think it's important to just be having those discussions. I think the other one, though, where we both can weigh in is compliance, right? And the law of unintended consequences. And I think whenever we have a branch closure and we see the renewed focus on things like CRA and CRA modernization and fair lending and looking at, okay, have you really thought out and documented your branch, I'll call it optimization strategy in light of the transition to digital? And how that may impact how somebody using hindsight and completely attributing maybe intent that you didn't have at the time to why you made the decisions you did on certain locations within your footprint. So I think making sure you're looking at it from all angles as we go through this, and not just the economics of it, which clearly are a key part of it, but some of these soft items, particularly given, you know, the significant potential for change November 3rd. I think we'll know a lot more later in the year about how some of this may play out. But again, if you looked at American Banker this morning, as I start every morning, and I'm not plugging for them, I just think some good summaries there. You know, they were talking about the impact of the election on those things, fair lending, because those have been some big issues and kind of what to look for. So I think, you know, make your plans, execute, but make sure you're documenting why.
Yeah, that's exactly right. As all of you know, we're coming out of the most benign regulatory environment in recent history, where we have heads of all these agencies who've been on the other side of exams. The head of the FDIC was general counsel of a major bank. And so they've been disruptors in the regulatory sense. They've seen what works and what doesn't work and what can be gotten rid of. You know, they made changes through Congress in the CRAPO bill to all of these stress test things and other formalistic requirements that were going down to the $10 billion asset mark. Now they're up to the $100 billion asset mark. So some of those have been enshrined in law that the Trump administration folks have done and would be harder to change. But there's other things in terms of supervisory policy that can very easily snap back. And so John's point is a good one, that right now, if polls are the way we think we're going to go, and I don't trust polls anymore at all. But if let's give the benefit of the doubt to them, and if Biden wins, we're talking about an entirely different set of priorities. I would imagine that fair lending is going to snap back. It was kind of dormant there under the Trump administration. That's going to snap back. I would imagine things like UDAP, unfair deceptive trade practices. John had mentioned CRA, particularly CRA in the context of closing branches in low and moderate income areas. That's really where I think banks are going to have to be thoughtful about how are they going to provide lending, investment, and services to those areas that they're missing. But there's going to be plenty about the exam process that I would imagine changing, and particularly with a focus on consumer compliance. We have to be mindful of the politics, notwithstanding the fact that we typically don't like to talk about politics in these arenas. The only other thing I'd say in the context of exams generally during COVID is that, even the examiners miss the face-to-face contact. I know for 20 years, we've been talking about our clients about getting the examiners out of the bank. They want them back now because they miss the face-to-face, the eyeball to eyeball. And when I talk to the examiners, they'll say, yeah, talk to your banks about making sure we keep that dialogue as well as we can in the age of digital discussions, right? So whereas before we would encourage our clients during exams to have frequent touch-ins during the examination, making sure that the examiners have what they need, addressing any issues earlier rather than later. But I would say keep that momentum going and almost pretend as if it's an on-site exam. So don't even just have telephonic check-ins. I would see, to the extent the regulators are willing to do Teams meetings, I know some of them don't use Zoom, but Teams meetings to have the eyeball to eyeball. I think you miss a lot seeing the facial expression. So I would encourage continued engagement along those lines.
Yeah, and John, that's a great segue into, and a lot of this is going to feel, kind of like it all overlaps, because it does, is I think the compliance, and that's another area, right? I think when you look, regardless of the outcome of the election, I think exam teams in general are going to be interested in how your operations changed as you went virtual. I think there's been a little bit of a grace period, I'll call it, and I'm sure some flexibility, and we've seen it for clients in dealing with regulators, but there's going to be things now that we're in the 6th, 7th month that we need to make sure we've kind of addressed and looked at. So, basic things like, have your compliance procedures changed now that you've got folks operating virtually? And are there maybe some gaps in whether it's BSA or my Reg E reviews or whatever that is based on your risk assessment? Have you kind of addressed that? More importantly, have you gone through the process of completing an updated risk assessment, and whether it's your compliance, operational controls, whether it's your controls over BSA, or it's your general kind of internal audit controls over financial reporting? Have you thought about the areas impacted? Certainly lending and the amount of, we made a lot of PPP loans off-site, but we've also done a lot of other lending off-site and renewals. We've done a lot of deferrals off-site. Have we modified our control framework at all as a result of that to kind of work around? And then that also brings into to frame or focus the whole IT environment and change. What workarounds? Are employees printing at home? If they're printing at home, is it confidential information? So you can go down some tracks where things it can almost feel overwhelming. So I would encourage you to really take a step back. And as we're going into year end, I know somebody earlier mentioned budgeting year end. I think it was John Friechak. And certainly as we're doing that, we're also thinking about wrapping up our internal audit and our risk, our enterprise risk programs for the year. And as we look to 2021, how are we incorporating the view of the changes as a result of COVID and how we operate now into those risk management plans going forward? I think is going to be critically important.
Yeah, when I think about risk management, I think of a car, right? Every car needs an accelerator and a brake. And regulators understand that banks need to be innovative these days. And we have plenty of them that are. We have some that are heavily into fintechs. We have some that engage in, seriously engage in international wire activity. We have some that are engaging in all things cannabis. And what I think the regulators would tell you, and unfortunately we've seen some of our clients get in trouble just over the last few months, is where there's a disconnect between the compliance infrastructure that you have and the innovation that you want. And so, you know, for example, I talk about this a lot, the 2014 guidance from FinCEN on cultural compliance, and I think that can be applied across the board, not just the BSA compliance, but to everything, that you really need to have risk management that matches how innovative you are, how risky you are. And that even flows to capital. I was talking to regulators just in the last couple of weeks about a bank that has monstrous amount of capital. I mean, double what you're used to seeing. And yet the regulator said because of the BSA risk, because of some of the international transactions, they are concerned about their level of capital. And, you know, obviously we push back on that, but you should be aware that those bare minimals and to be well capitalized under prompt corrective action is simply a minimum, and that you need to have a cushion relative to your complexity and risk. John, I think you mentioned on the cyber front, just this week, the CSBS, which is basically the trade group for state bank regulators, and the Secret Service came out with guidance on ransomware. I think we are seeing with COVID that all things cyber attacks are on the increase, and certainly being prepared for ransomware is one of them. And it really is a nice checklist that I think all of you should use to see what are our vulnerabilities, you know, what are our policies and processes around ransomware. And a lot of that obviously feeds into your whole cybersecurity awareness, and to the extent that you have the right controls on the IT side and the right oversight on the managerial side.
Yeah, I think you're spot on, and it's all about what's our stance ultimately as an organization, and are we aligned with what our risk appetite is across all of those areas, I think is really critical. One area I want to come back to, though, and it's an area that we've had come up a few times recently in discussions with clients as well as with their examiners, and that's around credit quality. And I know both John and Scott touched a little bit on that, and Kevin certainly gave us a nice preview of where the economy may be headed in one of three scenarios. But I think, you know, early on, you're seeing kind of this disconnect again between the big banks and the community and core banks we all work with every day, and all of you on the call, in terms of how the kind of top two quartiles within that, the economy have kind of withstood this initial wave of shutdowns and kind of the response to the pandemic, in that, you know, some were potentially over-reserved, and some of it was, you know, the adoption of CECL here in the U.S., but I think some of it is too, again, with the deferrals in place, until we truly see people come out of it and we see where their exposure is by industry and what that industry recovery looks like, it's going to be really hard to assess credit quality and the risks there. And so where you have clients that are clearly square, and what I'll talk about is we've got some clients where we're doing credit review where you had hotels that were in the middle of the stabilization process or were in construction, right? Clearly those are going to need issues. Clearly you're deferring and doing the right things. Do the economics behind it, but don't let the tail wag the dog here. Like, you've got to pass now on reporting, but still get your risk ratings right, document why you're making the decisions you're making, because at some point we're going to get to the other side of this, and you're going to need to really think about, are these credits really risk, you know, classified correctly, both from a regulatory and within my own risk rating scheme, right? And are my reserves aligned based on that? And the other place that comes into play, I think, is what Emily and John talked about, is if there is a transaction down the road, you want to make sure you've been kind of calling balls and strikes correctly based on what you think is going to happen. Because the other challenge has been, quite frankly, on the credit monitoring and really analysis side, is with the, you know, the delay in tax filings, and now we're going to get the final run of tax returns in for folks that had, you know, extended till today, is that financial results from 19 is really meaningless at this point, right? Like, I need to be talking to my borrowers and understanding where they're at, and my risk ratings need to really reflect how I've considered that. So I think that's another thing to really think about as you're looking at how you wrap up this year and you're building out your credit review plans for next year. Am I targeting the right segments of my portfolio, and am I getting proper feedback or good feedback based on current information from those borrowers? John?
Yeah, that's right. And having a firm and current understanding of your loan portfolios is so important for so many reasons that we've touched upon on this entire presentation. You know, the banks that I think were very lucky were the ones who've been examined in the last few months, you know, before some of those credit quality things increase. I think the ones who are going to be examined, you know, second quarter next year, maybe a little bit more scared about what's going to happen. But yes, it's absolutely the case that you need to be truly on top of, especially those segments of your portfolio that are impacted by the virus, and that's obviously transportation and hotel, and you know, anything we have a large group of people together in one place, that's going to be problematic, and keeping an eye on that. And it flows in so many other ways. You know, Emily touched upon the dividend issue. You know, one of the things that gets you an expedited versus non-expedited treatment is the extent to which you have CRE concentrations. And it also looks at, you know, what are your asset quality issues? I was on a call the other day with a client, and I asked, hey, just, you know, what's your classified asset ratio? Because the regulators want to know. And he didn't know off the top of his head. And if bankers to this day don't have that tattooed on their forearm on what that ratio is, that, you know, they better start getting in gear, because regulators are going to look at that number as the very first thing that they look at as really a proxy for the bank's health. And then beyond that, to those extent, and John and Emily touched on that, to the banks who want to be acquisitive, you know, if you have any hair on you from an asset quality perspective, it's going to be an uphill climb to be acquisitive. You know, Emily mentioned that DC, from the Fed's perspective, is starting to keep an eye on and conducting surveillance on what's going on with respect to all applications, not just the ones that would normally go to the board. And they're looking at things like asset quality. They're looking at things like, have you revised your assumptions since Corona? And, you know, all those things are important and really have to be done in real time.
Yeah, and the last thing I want to touch on, so we can leave a few minutes here if there's any more questions coming in, is around LIBOR. And I think that's something that everybody with COVID and everything going on has kind of moved out of their mind, and we're seeing it come back with questions from regulators. And you know, for our community and regional banks, you know, have you gone through the process of just starting to establish your steering committee, think about what do you need around this transition away from LIBOR, whether it's the SOFR or Ameribor or whatever that may be, and understand the impact that is going to have on your organization, whether it's in your loan portfolio, within your investment portfolio, could be within your treasury activities. I know this weekend we've got 80 trillion, and that's with a T, so I had to check my notes, in LIBOR notes that are going to reprice to SOFR over the weekend. And what is that going to do to pricing and kind of where we sit? So if you're a bank that hasn't started to look at this yet, you know, it sunsets, LIBOR set the sunset at the end of 2021. So I think at this point in the fourth quarter, using some time to build out who that steering committee is, getting some governance in place and starting to look at what you need to build your roadmap is going to be really, really critical to getting to the right answer here, because I expect regulators are going to start asking how you're going to manage that. John, I'll give it back to you, but Kevin, while we have you, I'm just curious, because you didn't touch on LIBOR, kind of what are we seeing and what are maybe the thoughts and projected impact there?
I'm sorry, you broke up there for me, John. Say again?
On LIBOR. So if you're looking at LIBOR today, what are you guys anticipating from an economic perspective, both within, I guess, banking and broader financial services, but what's kind of the sense around LIBOR today? Since we've got you on the call, I think it'd be good to maybe just spend a minute or two and get some perspective.
Well, the good news is that it's, from an economics perspective, it really is dwarfed by the other issues that are surrounding it. So it certainly is an important structural issue. So on the financial institution side, we recognize that. But as far as playing out even into markets itself, our view is that there are other issues going on that are probably more important. So it's become less of a focus over the past 6 months than, say, it was in January or February, and the potential for what you just outlined in the fall. So this weekend, sure, there's a lot of stuff happening, but longer term, minimal economic impact. And that's one of the reasons regulators give us such a long runway to be able to manage these from a structural standpoint.
Perfect. Thanks, Kevin. John, anything else you want to touch on around that or anything else before we hand it back to Mr. Fleetwood?
Yeah, before we go to Q&A, one thing we've been seeing in the last few months are banks that just have stale conflicts of interest and code of ethics policies that don't match what they're doing and that don't properly create, the kind of environment I think we want to see in banks, particularly in connection with ESG and other the issues that we've been seeing about in the news. So use this as a time, if you have a little free time, not that bankers do these days, to take a look at your code of conduct, your code of ethics, your conflict of interest policies, because unfortunately, just over the last few months, we've been seeing a few banks where they've had some rogue employees who've done some issues, and we've had to engage with them and the board on culture of compliance training. And really, if you can get to a place where you have that training before you need it rather than after the fact, it'll serve you better.
I could not agree more. Always want to be proactive, right? So as always, a pleasure, sir. Looking forward to doing this again in a couple of weeks for the Midwest Bank Leaders Conference. So a nice preview for those of you who will be joining us. But don't worry, I'm sure there'll be plenty that happens between now and November 5th for us to touch on that day. So with that, Rob, I don't think that's any questions in the queue, but I'll hand it back to you to go through that and sign us off.
Yeah, well, thanks, John. No, for those of you out there, if you have questions, start typing them now, and we'll try to get to them. We do have a comment, not really a question, and maybe throw it to Geiringer for 30 seconds here of, the virtual exam process. Someone commented that anecdotally it's been well received by banks, and that banks enjoy the lack of in-person examiners. I know you in the past have said be careful what you ask for. Everyone hated the in-person before, and now there's issues with the virtual. Any tidbits or kind of anecdotally as people ask questions that you want to give the audience in terms of virtual exams?
Yeah, I think there's a bit of a digital divide among banks. I think the banks who are already so used to operating in a virtual and electronic format are doing much better during this exam time. Our smaller banks, our community banks, who aren't quite as technologically savvy or where their conditions around their IT aren't maybe where they need to be, are having a tough time, basically having to scan documents, getting in a format where they can easily share it with the regulators. And again, it's that human touch that I think we miss. So on balance, the comments I've heard have been negative around these virtual exams, how much harder it is, how much more difficult it is to have the kind of conversations you need with the exam team. And what I would say is what I've been telling banks for years, which is have a good, solid first meeting with them where you talk to them about the good, the bad, and the ugly that are going on at your bank, a nice PowerPoint presentation. We found that those things have gone a long way, and then have a good exit meeting at the end as well. But in between, those touch points are supremely important because issues that normally could be solved by walking to the exam team's room and just throwing them a piece of paper just can't be done in the same way. So I'd recommend, really making sure you are thoughtful about the way in which you're going to operate in this new environment. From what I hear, examiners aren't coming into banks, certainly not this year, and probably not into next year as well.
Yeah, and as you were saying that, someone who's listening in commented that they're finishing their exam and they thought it was easier in part because they got kind of an advanced preview of what the questions were that they had, and they could prepare for them. So if there's any other questions, ask now, or you have all of our emails. We will make the presentation available for all who attended. Feel free to forward it along to your colleagues. I think we've got our emails are on the second or third slide of this. So, to the extent there's no questions right now, I want to, thank my colleagues at Barrick for taking time and addressing what they're seeing. I want to thank John Friechak over at Piper for his viewpoint, and of course our friends over at RSM weighing in and kind of leave it if anyone has any closing thoughts. Kevin, Christina, John, anybody? As we're wrapping up, we're sticking on our timetable. So John, looks like you have something to say, so I'll let you speak.
I was just going to echo, thanks, Rob, for the opportunity to continue to present with this great team, and thank you to Kevin and Christina and all the folks from Barrick and Piper as well for making time for us. So I think with that, everybody stay healthy, enjoy the start of fall here, and I'm sure we'll be talking to folks again late fourth, early part of 2021, which is kind of weird to say now, but I guess we're in the kind of final stretch here of 2020. So thanks, everybody.
Thanks all. Stay safe.